What's up, guys? Your agent Tyler Wehrung here, and today we're going to talk about housing affordability. With the extreme rise in home prices lately, there's been a lot of talk on the news and the media about, are houses still even affordable? Can people still afford to buy them? And kind of, should you even buy right now because the market is so hot? So while I think that decision is personal and everybody should kind of do that on an individual basis, I do want to point out a couple different factors when it comes to affordability that I think a lot of the media and a lot of the people that think about this kind of don't include. So we're going to talk about the Affordability Index, which is a tool from the National Association of Realtors, and kind of all the different variables that you should consider when deciding if you can afford a house or not. So with that, let's dig in. All right, guys, so let's jump right in here and talk about housing affordability, talk about all the variables involved. But before I do that, I just want to say this is a little more technical and in the weeds. If you don't really care about all the details and you just want to hear kind of the outcomes or look at some graphs, go ahead and jump to the timestamps below and jump to those points. But I'm going to talk about kind of the back end and kind of how these things come together. But I know that's not for everyone. So while we do that, let's go ahead and talk about the specific variables we're going to be looking at. And kind of when I use the term variable, I just mean all the pieces that kind of come together and tell the full story of affordability. So let's first look at P&I payment. P&I stands for principal and interest. That's the payment that you get from the bank. It does not include taxes and insurance. Those things are usually included in your full monthly payment, but to make things kind of area agnostic and kind of give a nationwide view, they exclude those pieces of the puzzle because some areas have way higher taxes and things like that. So this is just principal and interest based off the loan amount. So how do you come up with a principal and interest payment? One of the factors is the home price minus the down payment. Now, for the study that we're going to look at here, the Affordability Index, they assume a 20% down payment just to keep things consistent across the board. But your loan amount may be your home price minus 3% or whatever percent you're going to put down as a down payment. This is just showing the function of how we come up with a loan amount. And then your loan amount times the mortgage rate gives you your principal and interest payment. So those are kind of the three variables on how we come up with that final amount that you will be paying in a principal and interest payment. All right, and principal and interest payment is the primary factor when it comes to determining affordability. And I mean, that might seem obvious, but we at least wanted to state it here. Obviously, if the amount that you have to pay every month is a big factor in whether or not you can afford something. So just calling that out, and that is usually based off your income, but it's more importantly based on what that payment is as a percentage of your income. It doesn't really matter if, your just blanket income, but you want to look at that as a percent and come up with a healthy percentage that you feel comfortable expending every month on a housing payment. All right, so now let's jump into kind of the backstory of this affordability index. Like I said before, this is built by the National Association of Realtors, or NAR is how we'll refer to it from here on out. If you just Google this, you should be able to get like a couple months worth of data if you want to stay on top of this. But to get historical data, you do have to be a member of the Association of Realtors. So if you guys want any of this data, let me know. I'll be happy to help you out, try to find it. But basically, it measures whether or not the typical family could qualify for a typical loan on a typical house. Okay, so it's basically trying to take nationwide data. What is the average family? What is the average house, and could they afford it? So that's kind of the question they're trying to answer here. Typical homes defined by the national median price single family home. And again, if you guys want to dig more into this, just Google it. They talk about all this on their page. I'm just giving you a couple high-level points here. The typical family is determined by family income reported by the Bureau of Census. And prevailing mortgage interest rate, it's just saying they pulled rates based off of closed loans during this time period. So basically, it's using the median priced home, median family, and the average interest rate at the time of that they're looking at this. So how to interpret the data, or what this index is based on. So it's kind of the break-even point, or the middle piece of this is based off a value of 100. So a value of 100 means a family with the median income has exactly enough money to qualify for a mortgage on a median priced home. Okay, so anything above 100 means they have more than enough money to qualify for that median home. So, and again, this is assuming a 20% down payment on the median house there. So for example, a value of 120 on this scale would mean that the median family has 120% of the income required to purchase a median price home, assuming a down payment. Okay, so that will maybe help when we show kind of this next slide and get into the visuals of what the affordability index look like over the past 20 years. I used 20 years just to give a good number. We had ups and downs. We did have the recession back in 7, 8, 9, and 10. So you will see that in there, and then it also shows kind of the ramp up before that. So I felt like that was a good chunk of time, but if you guys want to see more data, just reach out to me. So let's take a look at this. So the 20-year affordability index, starting back over here, 2007 was a value of 120. So in that example I provided before, the median family had 120% of the income required to buy a home in 2000. And then this red line going across the middle here, that's the break-even point. So anything below that line would mean that the median family does not have enough money to buy a median home in that area. And for many reasons, the government has a lot of control here, and they obviously try to keep the affordability above that line, well above that line. People buying houses is great for the economy, and it's great for a lot of reasons. So you'll see here over the years we've maintained above 100. We got pretty close down here in 06, but since then we've kind of been well above and almost knocking on 200%, or double the income required to buy a median home back in 2012 here. So just wanted to show this, and I'm going to, in the next slides, I'm going to compare those other variables that we talked about in the beginning to this index, so you can see kind of how things trend in different directions, and kind of put all those pieces together. So I'm definitely a visual person, so this helped me kind of look at things and look at patterns, and I hope it does for you as well. So now let's put this affordability index up against median priced homes. So in this example here, we'll keep the affordability index as this blue line, the blue solid line, and the median priced homes throughout these past 20 years is this yellow solid line. And I've added a trend line in here. Those are the dotted lines. The trend line just kind of smooths out the ups and downs and gives you an average over that time period. So you can kind of see what direction things are trending in. So you'll see these are very close, trending in the same direction, kind of very slow up and to the right. But that median price homes have outpaced the affordability index, looking at a 20-year period. And you'll see kind of starting in 16 here, you'll see shooting up to the right for home prices, which concurs with the bull run in terms of home appreciation. Those homes that just started around 2015 to 16, just shooting up. So but you can see when we look at that same time frame, it really affordability dropped slightly. And then, you'll see in just a second here, mortgage rates dropped a little bit as well, which brought the affordability back up. So you'll see a lot of players, and I'll keep saying the government, but it's a lot of, governmental agencies have a lot of levers to pull on to kind of keep things consistent and keep things affordable to the home buyers, the consumers, us. All right, so if you guys want to look at these more, just pause the video to check it out, but I'm going to kind of blow through these relatively quickly, and let's jump over to mortgage rates. So like we mentioned on the previous slide, right around 2018, we saw affordability dip. So that means things became less affordable, and then you'll notice over here, right around 2018, we'll see just a little bit later, mortgage interest rates quickly decrease to follow, which then again make things more affordable. So again, just an example of how these levers play on each other, but this blue solid line is consistent. That is still the affordability, and the red line is mortgage interest rates for that 20-year period. So back in 2000, people were, the average rate was 8%. So things have dropped a lot, and I don't think a lot of people realize how lucky we are right now to be taking advantage of these sub 3% loans on owner-occupied single-family homes at this point. So this is early 2021. I think the data is only through February, so keep that in mind. But you can see this drop. If we look at the mortgage trend line, things just completely are dropping at a great rate. And how long will that last? Who knows? But just kind of shows the comparison of affordability and mortgage interest rates. So now let's look at affordability compared to the family or household income growth over that 20-year period. So I think we can all agree that $50,000 20 years ago is definitely not the same as 50,000 today. In fact, kind of that same household that brought in 50,000 back then is right up at 85,000, or somewhere in between 80 and 90,000 in today's standards. So the green solid line is the family income growth over that 20-year period. And the dotted line is the trend of that. So you can see these are very similar trends. Affordability is slightly, less aggressive than the household income's growth. But I think it just kind of goes to show that they are, very closely related. So let's look at now family income compared to the average or the median monthly payment. So the purple solid line is the median of principal and interest payment, and then you see some spikes and troughs here, but the purple line is relatively flat. If we even things out over 20 years, we've slightly gone from the scales over here, by the way, from just over probably $900 up to over 20 years we've only really increased $100-$200 in a monthly rent. Right now we're at probably 11 something here, right around 1100. So I mean, that's not really a lot in comparison. When we look at 50,000 to 85, we're talking $30,000 in household income growth over that same 20-year period. Monthly principal and interest payments only increased by $200 to $300. So that is a significant piece of data right there, and I think it'll show kind of on this chart. This is monthly payment as a percent of your household income. So back in 2000, people's principal and interest payment made up 20% of their take-home pay. So if they brought home $5,000 a month, $1,000 was going out the door in principal and interest payment. Whereas today, like we only saw that slight growth in principal and interest payment over 20 years, right? Today, we're looking at less than 15% of our take-home pay is going out the door in principal and interest payment. So that definitely helps out on the affordability side, and a lot of that is due to the mortgage interest rates. So just like to show that and give you a visual on kind of how those variables look like, how they've changed upward and downwards over these past 20 years. And hopefully that helps kind of paint a bigger picture around all the things that go into affordability. But here are kind of my final thoughts, and hopefully this resonated with you as well. But basically, you can't just look at one data point. Everyone talks about home price appreciation, but there are more things that go into it. And no matter what other people are saying, don't listen to the media or any pundits. Buying a house is personal. You have to look at this from your personal financial situation, your personal life situation. Where do you want to be? Where are you heading? And, kind of all those things have to come together and have to be a factor when you're thinking about buying a house. So you have to understand what you can comfortably afford. This doesn't mean, what houses are appreciating at, or what the, your pre-qualification is from the bank. You want to know what you personally think you can afford to spend on a monthly basis and not be underwater or kind of going paycheck to paycheck just to afford that payment. Being house poor is not a good place to be, and if anything slightly changes, you're going to be in a bad position. So highly do not recommend doing that. And then lastly, you want to think about buying a house. You still want to think about this as an investment. So no matter if interest rates are low and how prices are up, you can still afford it. You still want to think, about, is this a good investment for me and my family? And so look at value add opportunities. If you're concerned about, you think the housing market's at its peak and things might fall over the next couple of years, you want to maybe find some opportunities you can buy for less than market value today and kind of force appreciation up by buying a dated property that might need some work, or a property that you can maybe add another bedroom to and increase the value on. So kind of always keep those things in mind if this is something you might be concerned about. And then also understanding your exit options, which really just means how will I get out of this when the day comes that I want to sell and move on to a different property. So and you kind of have to think about these in worst case scenarios. So if the market falls and I still want to move, could I still rent this out and make money on it? Your mortgage payment is not going to change based on what the housing market does. So if the housing market falls by 20% and you couldn't sell for a profit, you could still hold it as a rental if you can get enough rent to cover your mortgage payment and some expenses on top of that. So, or do you say, I have to own this house for at least 6-7 years, and by that point, I will have paid enough principal down on the loan to where it doesn't matter if the housing market falls 20%, I'll still be able to sell and at least break even. Or, do you want to Airbnb it? Do you want to try to sell or finance it? Not saying any of these options are right for you, but just calling out that you want to kind of think through this as an investment, and so you don't get yourself underwater, and you kind of understand if the worst case scenario happens, I have a plan B prepared and I'm ready to execute against that if it comes. So it will help you sleep better at night when you think through all of this. But I hope this was helpful, guys, to at least provide some more color on all the things that go into affordability and what to think about when you're looking to buy your next property. So if this was helpful at all, I would love a like on the video. That just tells YouTube that other people should check it out. If you think someone might benefit from this video, I'd appreciate a share as well. But with that, guys, I'm Tyler Wehrung with Keller Williams, and we'll catch you next time. See ya.